coming to section 3 now, which talks about foreign liabilities. From here, we'll talk about the non-resident, part. What is the liabilities to the non-residents is covered in the section 3. So under this section, there are four categories, basically 4 points. One is we need to put in information about any capital or any liabilities towards non-resident shareholders having 10% or more equity holding. Second is in case there are investors which are having less than 10% equity holding, therein we need to provide information on the country-wise basis. Third is the portfolio investment, and fourth is the other outstanding liabilities. So when we have to fill in information, we need to first analyze how many direct investors have 10% or more holding. It asks for the number of direct investors because it will automatically open those many tabs. So number of direct investors holding 10% or more equity, and month and year of receiving FDI first time in your company. So it may be possible that, okay, 2017 or 2018, you had FDI, and then your non-resident shareholder transferred your shareholding, and for the next 3-4 years, there was no FDI. Now, again, you have FDI in your company by way of transfers or by way of fresh allotment, but you'll have to enter your first time you received your FDI, because RBI will then link your data accordingly that this company had FDI earlier also. Here we have to mention investor-wise details I mentioned. So name of the investor, country of investor, now the shareholding part, etc. In case, as I mentioned, in case there are less than 10% equity holding, so number of countries, how many countries we have these investors, we need to mention that number, and it will open tabs as per the number of countries we enter. Then the country-wise consolidated information. So what information is required to be mentioned in both the above scenarios? First is the equity and participating preference shares. So you'll realize I mentioned in my previous slide that participating and non-participating preference shares have been categorized differently for a particular reason. See, participating preference shares are treated at par with equity because they also have a right in the surplus profits or surplus dividend. Non-participating preference shares are treated differently. They are treated as other capital, or they are treated as quasi debt. So they are not considered in the equity and participating preference shares. For example, the terms of your preference shares does not mention whether these are participating or non-participating. So generally, if the terms does not mention anything, so we consider those as non-participating, because preference shares per se do not have any right in the surplus profits. Only if your terms prescribe that they have a right either to dividend or to surplus profits or surplus reserves, or both, then only you have to consider those as participating preference shares. So then the second part is other capital. In other capital, we have to mention if there are any liabilities to the direct investors. So this may be in the form of non-participating preference shares, borrowing and lending, for example, ECB or any loan received, any debt securities, NCDs, for example, issued, or CCDs you issued, any trade credits, financial leasing, share application money, which Sneha talked about. If there is a share application money, companies are not required to file FLA. Just to clarify a bit more on that, in case you already have FDI as of 31st March, then you need to fill in this FLA. And the share, and if you have received share application money, say on 15th of March, and you have allotted shares in April or May within the 60 days time period, the share application money amount will come under other capital. It will not come under equity share capital. And if you have received the FDI first time in your company, again, say on 15th March, and you have not allotted share capital, so you do not have FDI. So you don't need to file FLA on that basis. Right. Third is the information required to be mentioned about if there are any disinvestments made during the year. So disinvestments means your non-resident shareholder have sold the shares during the year. It may be by way of transfer, you filed FCTRS, etc. Or there was a buyback in the company. A company has purchased the shares, so that is also considered disinvestments. So one may refer to the ODI regulations also, where disinvestments is more clearly defined. So in case there is any disinvestment, that figure needs to be mentioned here. So to reiterate, in case investors are having 10% or more equity holding, all these informations are to be mentioned on the basis of each investor. And in case of less than 10% shareholding, then these have to be mentioned on the basis of country-wise consolidated information. Third is the portfolio investments. So portfolio investments is generally in case of listed companies, like less than 10% non-resident holding is considered as portfolio, unless if any company specifically even less than 10% shareholding is held under FDI scheme. So there is no restriction that listed company cannot have FDI. Can have 1%, 2%, any number less than 10% also. But if it is under portfolio scheme, say purchased in the secondary market, then it will come under portfolio investment. So in case a company has a portfolio investment as well as FDI, so we need to mention the percentage of equity and participating preference share capital holding under FDI also, and then equity securities at market value. In case of unlisted companies, as I mentioned, the net worth is calculated and non-resident shareholding is calculated, amount is calculated automatically by the system. Let's say your net worth is, let's say, 1 CR, and your non-resident shareholders is holding, let's say, 15%. So 15 lakh will auto calculate in the figure. Here, in case of portfolio, there is no concept of net worth. It is at market value. Listed companies have market value on a daily basis. So these securities are to be mentioned as at 31st March market value. Then debt securities. If the company has any issued any money market instruments, bonds, and other instruments of maturity of more than 1 year, non-participating preference shares and debentures held by foreign investors who does not have any equity participation. In case the investor has an equity participation, it will be covered in point number 1 or point number 2, more than 10% or less than 10%. But if there is no equity participation, means no equity or participating preference share, this may be case of CCPS or CCDs also. One might think CCPS is capital, why not cover in the capital part? But if your CCPS are non-participating, then you have to mention this investment in the debt securities under as a non-participating preference shares. So this is a very confusing point, but I just wanted to clarify on that part.
Maybe Chandan, for the benefit of audience, if you could again clarify what is participating and what is non-participating instrument.
Sure, Sumit. So participating is where the preference shares have the right either in the surplus dividend after the dividend is distributed to the equity shareholders. So there might be a surplus dividend or surplus profits or surplus reserves. If the preference shareholders have right in either of these, so then those become participating preference shares, which means they have a right in the overall net worth of the company. But if there are no such rights, those are considered as non-participating preference shares, even though that is considered as a share capital. But those are non-participating preference shares. Those have a nature of quasi debt only, because you've put in 100 rupees, you will get some coupon rate, let's say 1%, 5%, 10%, whatever is given, and you will get back only 100 rupees. You don't have any share in the surplus. So that is more of a nature of a debt. That's why that is covered in the portfolio investment.
Yeah, but all these, the investments that are made in startups by the VCs and the PEs, and generally the instrument that is used is CCPS, compulsory convertible preference shares. Now, in case it is not mentioned anywhere, is it participating or non-participating? Then what would that be?
So I cleared that earlier also, Sumit. So in case it is not mentioned, so we have to consider those as non-participating preference shares, because preference shares per se do not have any rights in the surplus. Right. They have a preference over the equity shares as per Companies Act. So having a right in the surplus makes them participating or non-participating shares. Okay. So again, the disinvestments in India during the year, same as I mentioned in case of FDI, in case there is any disinvestment under portfolio investments also, we need to mention that. The fourth category is the other investment, which is a residual category. So point number 1, 2, and 3 are generally on the basis of related parties. So related parties are like, defined in the accounting standard, not as per Companies Act generally, because we have to fill in the entire information on the basis of a balance sheet. So related parties mentioned there, which covers your, majorly on the basis of your investors, your shareholders, holding companies, subsidiary, associates, fellow subsidiaries, those are covered as related parties. Other than those, there are, there are unrelated parties. These may be, for example, you have trade relations with any of the foreign entities. You simply, do sale or purchase. So trade credit, for example, you have certain liabilities towards trade credits, or you've taken loan from any party other than your related party. So that will be covered here. Currency and deposits, or if any other payable accounts, those will be covered under this category. No, very important point here. We've talked about foreign, now related parties and unrelated parties. So I'll go to the previous slide again. So here, in the first part, we mentioned 10% or more. You mentioned equity and participating preference shares, other capital disinvestments, etc. In the second case, investment in India under FDI scheme having less than 10% equity holdings. So this is on the basis of related parties. So you might have certain related parties which do not have any equity participation, right? For example, any fellow subsidiary, you have a fellow subsidiary in Germany, for example, with which you have certain relations, trade relations, and you have to pay, trade liabilities to that company. So you have to consider that also when you consider the number of countries. It's not only about how many countries you have share capital with, right? For you have investors, but you need to also consider if you have any other liability to a related party, that also to be mentioned in the number of countries. First you need to consider that and then put in that information. So there will be two sections, equity and other capital. So under other capital, then you'll have to mention, okay, towards trade credit or whatever, you have to mention that information. One more pertinent point is, for example, I gave example of your fellow subsidiary in Germany. Suppose you have some outstanding with that fellow subsidiary. You had that outstanding last year, but this year you do not have. But you have to mention numbers about previous year as well as current year. So therefore, while considering the number of countries, you have to consider any outstanding liabilities with by your company in the previous year also. So suppose you have 10 countries today, you had 8 countries last year. Out of these, 6 are common, right? So which means your company had outstanding liabilities to two countries last year, in addition to the 10 countries mentioned. So you will have to then consider 12 as a number of countries. In the current year number, you'll have to mention 0, and for the previous year, you'll have to mention 2. I hope that is clear. So this is all about foreign liabilities.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000+ laws and 24,000+ compliances. All in an integrated platform that is easy to use with automated alerts and risk management capabilities. Is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management. Request a demo at complinity.com.